Why do 95% of traders lose money? Have you ever felt that frustration, watching your account shrink while big banks report billions in profits? You study the charts, you follow the rules, but it feels like you're always one step behind, caught on the wrong side of the move. It's a demoralizing cycle that forces most people to quit. So what's their secret? Is it just luck? Do they have some mythical indicator that predicts every turn? The answer is no. In fact, the conventional strategies taught to the public are often the very tools that make you predictable. They effectively paint a target on your back. The truth is, they play a completely different game. They aren't just participants. They are the architects of the market. They move prices with intention, engineering liquidity, and creating patterns designed to do one thing: take your money to fill their massive orders.
Today, I'm going to reveal their playbook. I'll show you the exact techniques banks use to engineer false breakouts, hunt clusters of stop losses, and accumulate their huge positions while retail traders are panicking. This isn't theory. These are the actionable mechanics of the market. More importantly, you'll learn how to spot these institutional footprints and align your trades with the smart money. Imagine finally trading the market's biggest players. If you've ever been stopped out right before the price takes off, this video will fundamentally change how you see the charts forever.
So forget everything you've been taught about lagging indicators and magic systems. It's time to learn the reality of how the market truly works. Let's begin. First, let's be real. The Forex market isn't the level playing field you've been sold. It's not controlled by you, me, or your favorite trading guru. The popular narrative that anyone can easily outsmart the market is a dangerous myth, one that provides the very fuel these institutions need. It's controlled by institutions, central banks, hedge funds, and big money players with billions in liquidity. These aren't just participants. They are the market. Their immense capital gives them the power to influence price in ways a retail trader simply cannot. They don't follow trends, they create them, and they don't trade like retail. They aren't staring at lagging indicators like RSI or MACD. Their game is governed by one all-important principle: liquidity. They need to fill enormous orders without drastically moving the market against their own position, and that requires finding a large pool of counterparties. Imagine you want to buy 10 billion worth of EUR USD. You can't just press buy. The slippage would be catastrophic. You need sellers. And where is the most predictable concentration of sell orders? Clustered right below key support levels, where countless retail traders have placed their stop losses. This creates a giant pool of liquidity. That's why banks hunt them. They deliberately push prices into these zones to trigger those stops. This is why your perfect breakout trade keeps failing. It suddenly reverses, stops you out, and then rockets in your intended direction. It wasn't bad luck. It was a liquidity grab, and your stop loss was part of their plan. You see a breakout, enter long, and boom, price reverses and hits your stop. Why? Because that breakout wasn't real, it was engineered. Banks move the market in phases: accumulation, manipulation, distribution.
The question is, how do you spot these moves before they happen?
Order blocks. Banks leave footprints where they enter trades. Fair value gaps, imbalances in price that usually get filled. Liquidity zones. The levels banks target for stop hunts. Price sweeps above a recent high, breaks structure, retraces to an order block. That's where the big money is getting in. Stop trading breakouts blindly. It's a classic trap where your stop loss becomes fuel for the market's real move. Instead, use this professional blueprint. First, mark key highs and lows. These are major liquidity pools. Then, be patient. Don't chase the initial break. Wait for a clear market structure shift which confirms the institutions have revealed their hand and the true intended direction. Now for the entry. We don't chase price, we let it come to us, entering on a retracement to an order block. On this EUR/USD chart, price sweeps the Asian session high, grabbing liquidity. Then, an aggressive move down breaks market structure. The pullback returns precisely to the order block created during that drop. That's your high probability entry, aligning you with institutional flow.
The banks are not against you. They're just playing a game you weren't taught. A game of liquidity. They need your orders to fill their massive positions. By understanding this framework, you're no longer the pawn. You can anticipate their moves and trade with the current, not against it. Now you know the rules.
If you're ready to stop being liquidity and start trading like the institutions, hit that like button and subscribe. My next video on mastering order blocks is the critical next step on this journey.